Today I'm going to demonstrate a trading strategy that I recently found on YouTube in a video by a trader called Scott Welsh. He talks about how using this simple trading strategy on just one Forex pair can be a much better alternative to buying and holding in like an index fund for a longer term investment. So I thought I'd test it out for myself, and I'm pleased to say that it is a profitable strategy and I do quite like it. So hang around to the end of the video where I'll show you exactly how we're going to trade it and how I've made a minor but very significant change to it which will increase the overall profits. I'll link his original video down in the description below, but let's talk about the rules of the strategy. We're going to be looking at pound-yen Forex pair. Now this Forex pair, from my experience, does trend very well, and Scott has also found this out himself. So we're going to be using a classic breakout trend following strategy, and it doesn't get more classic than a 20-day breakout or using a DONCHIAN channel on your chart to identify 20-day highs and 20-day lows. So we're going to be buying when the price breaks above that 20-day high and short selling when the price breaks below the 20-day low. Like me, he also likes to use a fixed pip stop loss, and he also uses a fixed pip profit target and an all-important timed exit for this strategy. I'll explain a little more, and we'll be testing each step of the process when we move over to the computer. So let's go and have a look at that now. In Scott's video, in his testing, he's actually testing from 2003 through to 2021. Now I'm not going to test that far back. I'm going to go back to 2008 through to 2021. So when we look at things like his stop loss and his profit targets, we do find slight differences in optimal numbers, and he might have used his large data set to find the best number, and I'm using slightly smaller data set. So that's why there's going to be slight differences in the numbers, but nothing significant. Let's have a look at the first chart where I'll show you the entries and the exits. You can see we've got a daily chart or a 1440 minute chart of pound versus the yen. And I've put some DONCHIAN channels, which are these cyan lines on the chart, and they're marking the 20-day highs and the 20-day lows. So when the price breaks above, like this buy trade here, we buy. Well, we were short, so we've exited the short and then we buy, and then when the price breaks through the 20-day low, we exit that long position and then we go short. And so it's a stop and reverse strategy, apart from when we get stopped out, or we hit a timed exit, or we hit the profit target. But at the moment, all we've got is the buys of the 20-day high and the shorts of the 20-day low. There is no stop, timed exit, or profit target at the moment. So let's have a look at the results. And there's the equity curve, which is positive, but pretty horrible. I don't think any of you would want to be trading that. Neither would I. So let's move on and introduce the timed exit. So in this workspace, we've got exactly the same strategy, but we're using a timed exit. We're saying that we only want to be in the trade only for 5 days. And we can see that, for example, this trade here, we've bought mid-session or towards the start of the session. Then we've held for one day, 2 days, 3 days, 4 days, 5 days, and then we've exited. And you'll notice that I've actually gone down to a 15-minute chart here. We're still using the same signals, we're still using the signals from the 20-day high and the 20-day low, but we've moved down to a 15-minute chart, and the reason for that will become apparent a little bit later on, but the results are going to be essentially the same. But now we've got that 5-day timed exit. So let's have a look at the results for that now. Looking at the equity curve, we can see it's much better. That timed exit really has made all the difference. We're making 7.9 million yen. Got an average trade of 27,000. That's good. Percent profitable is 53%. It's going to be low on this type of trend following strategy. We've got quite a largest losing trade at the moment because we're not using a stop loss. So I tested his 5-day exit, or I actually done an optimization to see if 5 days was the best or not. And here's the results of that optimization. You can see I've got this input called timed exit, and currently we're using the 5 days, and these are the results you saw with an average trade of 26 or nearly 27,000. And you can see, looking at the net profit and the average trade, the best in my optimization is actually 13 days. But I can see why he's used 5. It's a nice stable area in terms of net profit and average trade. But out of interest, let's have a look at using the 13 bars. Looking at the equity curve, it's still a nice equity curve using 13 days for that timed exit. We already know that the average trade is much higher at 60,000 yen. We have got less trades because we're staying in the trades for longer. And we are making more net profit at 11.4. But for this test, we're going to stick with the 5 days that Scott originally used, and I'm more than happy to stay with the 5 days. So in this next workspace, we've gone back to the 5 days, but we've introduced the stop loss, and he recommended a 140 fixed pip stop loss. So let's have a look at the performance now. We've got more net profit, 8.9. We've got a less strategy drawdown now of only 4.1 million. The average trade is very similar to what it was, but our largest losing trade is much smaller now at only 182,000 yen. So we have experienced a little bit of slippage because our stop loss was at 140,000, but that's quite normal. But is 140 pips the best stop loss? Because to me, on pound yen on a daily chart, 140 does seem a little bit small, but let's test it out. Let's have a look. So I've run an optimization from 0 using no stop loss all the way to 500 pips down the bottom, and currently we're using 1.4, or which is equivalent to 140 pips. And looking at the net profit and the average trade, 140 does look quite good. It's not the best, but it does look quite good. There are some high net profits very early on, but I would say on this sort of strategy, anything up to 100 pips is probably far too small, and it reduces our average trade quite a lot. Personally, I prefer something a little bit larger, probably around about this one here, 2.22. If it was down to me, I would probably stick with maybe a 200 pip stop loss, but 140 definitely is a good stop loss, so we're happy to stay with that. So in the next workspace, let's introduce the fixed pip profit target, and Scott recommended 450 pips. So that's what I've done now. I've inserted that 450 pip profit target, and let's have a look at the equity curve. I don't generally like fixed pip profit targets, but there are some merit for them somewhere, and looking at the equity curve, it's still quite nice. We've got more net profit at 9.8 million. The average trade is slightly smaller. We've got more trades, and I noticed that we do have a smaller drawdown using the 450 pip profit target. But let's test that 450 pips. So again, I've done an optimization on the profit target, and I've optimized from 0 through to 1,000 pips. At the moment, we're on 4.5 here. So comparing it to no profit target at all, we've gone from 8.9 to 9.8, so more net profit, more trades. The average trade, I said, is smaller from 26,000 down to 22,000, but the max intraday drawdown, look, 2.4 million yen as opposed to 4.1 million yen. Looking at the results from my optimization, I would say that the best profit target is probably around about 650 pips, so a little bit higher. We've got a better average trade, better net profit, and the intraday drawdown is not much different whatsoever. So if I was to pick a profit target, I'd probably pick something a little bit larger, like 650 pips. But I am happy to stay with the 450, which Scott recommended. For those of you who have seen the previous video that I'd done, actually, I think that was on pound yen Forex pair, I talked a lot about the wide spreads around about the closing and the opening times of the session. And those spreads tend to widen towards the end of the session, which is 1700 Eastern Standard Time. So from about 1645 onwards, and then they don't come back to normality for about another 90 minutes, 2 hours later, until about 1830 hours. So in actual real-time trading, I like to avoid those areas if I can to actually place the trades, because if you've got a massive spread, and they can be really wide, pound yen can have a spread of up to 15 pips as opposed to 2 pips normally, or less than that. So avoiding trading at those times can be very beneficial. So the next thing I'm going to do is actually introduce a filter to stop us trading within a time window where the spreads are very large, and see how that affects the performance. But before I do that, if you're enjoying this video and like this sort of test, then please hit the thumbs up on this video now and subscribe to the channel if you want to see more videos like this one. So in this next workspace, I've introduced that time window, and I'll just show you. I've said we only want to start trading if it's 1845 or later, and we want to stop trading at 1630. So I've excluded 2 hours and 15 minutes around the end and the start of the sessions to really avoid those big spreads, because with like the timed exit especially, if we were in the trade for 5 days, then the exit was exit after the end of that 5th day, which was when spreads are going to be wide. And we could also have some entry signals like the 20-day high or the 20-day low could be broken around the time where those spreads are very wide. So this avoids trading at those times, and essentially it's going to make the back test much more in line with real-time trading, with real-time spreads. So let's have a look at what it's done to our performance report. The equity curve is still similar. We're making a little bit less net profit, and the average trade is slightly smaller. However, in reality, like I just said, in real-time trading, because we're only trading now with narrow spreads, we are actually going to be making more profit, although the backtest doesn't actually show that. I could, of course, optimize that time window, but I don't want to optimize it. All I want to do is specifically just avoid that area of wide spreads. And the next thing I want to do is, just out of interest really, is look at the stop loss and the profit target that I preferred, or from my testing. And the profit target I liked was 650 points, and the stop loss preferred was 200 points. And we're still using that time window. The equity curve I think is a little bit nicer early on. The net profit isn't too much different. We are making a better average trade. However, if I remember, the drawdown is slightly more. So we've got increased drawdown, but we have got a slight increase in the average trade. But those minor differences in my stop loss and profit target, as opposed to Scott's original stop loss and profit target, is really, really minor. So either one is going to work just fine. And like I said at the start of the video, the reason for the differences are probably because I'm optimizing using a data set from 2008 to 2021. He probably did it from 2003 to 2021, and that's why there's minor differences. So as you've seen, my results are also positive too, and I think it's quite a nice little strategy. And it's one that can be traded without the use of automated software too, because it's very simple looking at the daily charts, looking at those highs and those lows. As Scott mentioned in his video, the nice thing about trading in and out with a strategy within 5 days in this example is that after every winning trade you can increase your position size. So over the years you can compound your gains, and that makes a massive difference, and a big difference to just buying and holding with an index fund. So thanks for the video, Scott, if you're watching, and I've also watched some of his other videos and enjoyed those too, and I definitely encourage you guys to go over to his channel and have a look, because I think you'll enjoy them as well. If you have any comments or questions, then please leave them below and I'll do my best to get back to you. But until the next one, this is Jared Goodwin, and thank you.